For generations, the mathematics of wealth creation rested on a simple, unshakable premise. Buy assets for less than their intrinsic worth, wait for the broader market to recognize the discrepancy, and harvest the resulting difference. This was the bedrock of value investing, a disciplined philosophy famously championed by Warren Buffett and institutionalized by the greatest financial minds of the 20th century. It relied on a deep understanding of corporate balance sheets, tangible assets, and steady, predictable cash flows. Yet entering the post-financial crisis era, this foundational strategy seemingly collided with an invisible wall, forcing a profound reckoning among institutional and retail investors alike. Between the years roughly spanning 2007 to 2020, the traditional metrics of intrinsic worth appeared entirely broken. The 2007-2020 market cycle became a punishing wilderness for orthodox value managers who adhered strictly to historical valuation models. During this prolonged stretch, the struggle against growth stocks, particularly those concentrated in the rapidly expanding technology sector, was not just a temporary cyclical rotation. It was a fundamental divergence that led many seasoned market participants to question if the old rules of capital allocation were permanently obsolete in a newly digitized world. To understand the mechanics of this massive divergence, one must look closely at the unprecedented macroeconomic environment engineered by global central banks. In response to the severe economic contraction of the late 2000s, monetary authorities unleashed quantitative easing, fundamentally altering the baseline cost of money. By systematically purchasing trillions of dollars in government bonds and mortgage-backed securities, central banks artificially suppressed yields and flooded the global financial system with excess liquidity, creating a unique environment where capital was aggressively abundant and nearly free to borrow. This prolonged era of zero-interest rate policy acted as a massive form of financial leverage, specifically favoring future promises over current realities. In traditional financial modeling, the present value of a company is determined by estimating its future cash flows and discounting them back to today using a specific interest rate. When that discount rate artificially approaches zero, the mathematical penalty for earnings that are 10, 20, or even 30 years in the future virtually disappears, making distant, hypothetical profits infinitely more valuable in the present day. Consequently, the specific market conditions of the 2010s created a massive structural premium for corporate expansion and technological disruption. Companies promising exponential revenue expansion and total market capture were rewarded with astronomical valuations, even if they completely lacked current profitability or a clear path to generating free cash flow. Growth stocks became the ultimate beneficiaries of this zero-rate gravity, as investors willingly paid massive valuation multiples for the mere potential of future monopolistic dominance. Conversely, traditional value sectors found themselves severely penalized by this new paradigm. Industries like commercial banking, energy extraction, and heavy manufacturing inherently require massive capital expenditures and operate on thinner, highly cyclical profit margins. In an environment flush with cheap capital, their steady, immediate cash flows and robust dividend yields were deemed entirely unexciting compared to the limitless, borderless narratives spun by emerging software and internet platforms. Beyond the artificially low cost of capital, the very nature of corporate value was undergoing a profound and permanent structural evolution. Classic value investing relied heavily on tangible, easily verifiable metrics like the price-to-book ratio, which measures a company's market capitalization against its hard physical assets. Factories, massive inventory stockpiles, and prime real estate were the traditional collateral of the industrial economy, easily quantified and clearly recorded on a standard corporate balance sheet. However, the 21st century economy shifted aggressively and permanently toward intangible assets. The most powerful and profitable companies in the world were no longer building massive steel mills or sprawling physical retail networks. They were writing proprietary code, securing global patents, and building inescapable digital ecosystems. Intellectual property, brand equity, and powerful network effects became the primary drivers of massive corporate wealth. Yet these crucial assets were largely invisible to traditional, backward-looking accounting standards. Network effects, in particular, introduced a revolutionary form of operational leverage that traditional value screens completely failed to capture or comprehend. A global software platform that costs billions of dollars to initially develop might cost absolute fractions of a cent to distribute to its next 10 million active users. This dynamic meant that once a technology company achieved critical mass, its profit margins could expand at a rate entirely inconceivable to a traditional manufacturing firm constrained by physical logistics and raw material costs. The economic shifts caused by this aggressive transition to an intangible, digitally driven economy rendered traditional value screens highly vulnerable to generating false signals. A company trading at a seemingly attractive low multiple of its tangible assets was very often cheap for a perfectly logical reason. Many of these historically inexpensive companies were facing imminent structural obsolescence, trapped in legacy business models that were being systematically dismantled by agile, well-funded, tech-enabled competitors. For the individual portfolio manager and the institutional allocator alike, this dynamic created the dangerous, wealth-destroying phenomenon widely known as the value trap. Adhering strictly to low price-to-earnings or historically low price-to-book ratios often meant unknowingly accumulating a concentrated portfolio of permanently declining businesses. Investors patiently waiting for a historical reversion to the mean found themselves holding stranded assets, while the broader market indices were propelled to consecutive record highs by a concentrated handful of mega-cap technology monopolies. Analyzing this specific period requires directly acknowledging the severe psychological toll on disciplined, fundamentally driven investors. Watching speculative, highly unprofitable enterprises multiply in market value while fundamentally sound, dividend-paying companies stagnated severely tested the resolve of even the most experienced capital allocators. The sheer, unprecedented duration of this relative underperformance led to widespread industry capitulation, with many seasoned professionals abandoning their strict valuation disciplines simply to chase market momentum and avoid career risk. Yet the echoes of that long zero-rate era eventually and inevitably met the hard, unforgiving limits of physical economic reality. The definitive turning point arrived with the massive global disruptions of the early 2020s, which violently shattered fragile, optimized supply chains and ignited a fierce resurgence of global inflation. The specific macroeconomic landscape that had nurtured the unquestioned supremacy of long-duration growth assets was suddenly and violently upended, forcing a massive repricing of risk across all asset classes. As inflation surged to multi-decade highs, global central banks were forced to aggressively and rapidly reverse their long-standing accommodative monetary policies. The baseline cost of capital, artificially suppressed for well over 10 years, rapidly normalized to historical averages. This sudden, aggressive spike in baseline interest rates acted as a brutal, immediate gravitational pull on the inflated valuations of high-growth, long-duration technological assets. When the macroeconomic discount rate rises sharply, the mathematical penalty for distant, hypothetical future earnings returns to the market with absolute vengeance. Companies that had relied entirely on a continuous flow of cheap debt and equity to fund their endless expansion suddenly faced a highly hostile, unforgiving financing environment. The broader market's focus ruthlessly and swiftly pivoted away from hypothetical total addressable markets back toward actual, immediate free cash flow and robust, highly defensible corporate balance sheets. In this renewed, highly disciplined environment of capital scarcity, the foundational principles of traditional value investing clearly demonstrated their enduring absolute relevance. Traditional, capital-intensive sectors that had been starved of investment and widely dismissed as relics of the past, such as traditional energy and physical commodities, suddenly exhibited massive strategic leverage. Their unique ability to generate immediate, tangible cash flow in a highly inflationary environment made them indispensable, stabilizing anchors in an increasingly volatile global market. However, the critical lesson of the preceding challenging decade is absolutely not simply a triumphant, uncritical return to the exact strategies of the past, but rather the absolute necessity for continuous analytical evolution. The true underlying intrinsic value of a modern business today simply cannot be accurately calculated without fully acknowledging the undeniable power of intangible assets and highly defensible digital moats. The strict definition of value must continuously expand beyond mere statistical cheapness to fully encompass the true durability of a company's competitive advantage in a highly technologically advanced landscape. Modern resilient portfolio construction demands a careful, deliberate synthesis of these seemingly opposing investment philosophies. It requires the strict, unwavering discipline and demand for a margin of safety inherent in classic value analysis, seamlessly combined with a forward-looking, highly realistic appreciation for modern operational leverage and ongoing technological disruption. Investors must actively seek out companies that possess both the current, undeniable financial strength to weather severe economic storms and the strategic, intangible assets necessary to compound wealth aggressively over long periods of time. Ultimately, the widely perceived failure of value investing was largely an optical illusion created by a highly unique, historically unprecedented confluence of experimental monetary policy and rapid technological revolution. The underlying foundational principle of buying a dollar for 50 cents never actually ceased to be true. What fundamentally and permanently changed was exactly how that dollar was generated and how it must be accurately measured. Confidently navigating tomorrow's complex financial landscape requires the strict analytical rigor to see clearly beyond outdated traditional accounting metrics and the strategic foresight to recognize true intrinsic value wherever it genuinely resides.